All right, in this presentation, we'll be discussing auditing cash. The key accounts when you're dealing with cash are usually accounts receivable because that's the major inflow of money into a business is those credit sales. Now, if you're in a cash business like a restaurant or something like that, then you might see more coming in from cash sales. So there's extra controls that need to be around that. You'll see interest revenue come in. You also see the various expenses that are used to buy things. But that's why accounts payable should be also on this list because a lot of times those expenses are put into payables and then cash is then released to pay off those payables. You'll move money between different cash accounts a lot of times, usually to try to maximize whatever interest you've got, keeping things in savings as best as possible before you move them over to a checking account, which usually doesn't bear interest in it. And then you'll also see transactions between investments or marketable securities. When it comes to cash, there's a few key audit assertions. First off is existence. Does that cash account really exist? Is there a bank statement? Is it a valid bank? All these things to make sure that it really does exist. Next would be completeness. Are all the transactions going in and out of the general ledger for that cash account as you would expect? On the flip side of that, when you look at the bank statement, are all the transactions going in and out of the bank statement as reflected on the general ledger? Next is rights and obligations. Do they actually own that account? Are there loan covenants on that account that put restrictions on it? Next would be valuation. What if it's foreign currency in a foreign bank? Has it been translated properly so that the right value is reflected on the financial statements? And finally, the presentation and disclosure, in case there are things that do need to be disclosed or presented differently, especially when it comes to loan covenants. When it comes to cash, there are lots of inherent risks. One of the biggest ones is the volume of activity. You'll go into a client to do an audit and you'll see tons of transactions, lots of in and outs, maybe even between accounts, maybe even between subsidiary companies. I mean, if you look at some of the car dealerships around, you'll notice that a lot of them have the same name, yet they'll have Dodge, Ford, Subaru, yet they have all the same names. Well, there's a lot of transfers of both cars and money that go between those uh, companies. So that's something that can be overwhelming at times. Next would be liquidity, the ability to turn that cash or move that cash around, and it might make it easier to steal. Next would be automated systems. There's a lot of auto pays out there, EFT transactions, lock boxes, which are when customers make payments to a bank and they go to a particular lockbox that will then flow activity into the cash account of your client. Online banking now makes it even easier for people to do certain transactions, so you want to make sure there's restrictions on those. And then even payroll. You have a company like Paychex or ADP that will automatically sweep out payroll, both the net pay for the employees and the taxes for the government on a weekly basis or biweekly basis, depending on when they're doing payroll. You've got debt covenants that need to be revealed to you so that you know if there's a required cash balance. So let's say you've got a large credit line that the company may have. So that's one of the indicators for a debt covenant is potentially a credit line that then a bank will have in its wording, you must keep $50,000 in your cash at all times, or we will do something related to the debt or the credit line. And finally, cash is just susceptible to a lot of outright theft, whether it's the money coming into the account through skimming schemes, which we'll talk about in a minute, and also when someone who has the ability to write checks or has that signature stamp, they can figure out ways to divert cash out of the bank accounts into their own accounts or even set up fake accounts with the company's name on it that they have complete control over. So these are all things that you worry about when it comes to cash. Common schemes when it comes to cash is an employee might purchase company merchandise at a special unauthorized discount. So what they'll do is they'll use potentially that cash register, or if they can do behind the scenes work to do this, they'll hit special discounts that they're not entitled to. But one of the common things that I'll see is you might have a couple friends come in and you'll hit your employee discount. Might be a family discount or whatever for those individuals, and they'll take that discount even though they're not technically supposed to do that. Employee can also steal cash before it actually gets into the accounting system, and that would be called skimming. So again, the bartender situation where they tell the individual that it's $10, but they only charge $6 in the cash register, and they pocket the other $4. That's skimming. Or they might do that $10, charge them $10, then hit a special discount on the register, and make sure they uh, know how much money that they can take out of the register at the end of the night. They could also falsely void or credit a sale and steal the cash. So, oh, you got that $10 drink. Thank you for the $10. They enter that and then they void it and then they pocket that $10. Employee gets a check written to a fictitious vendor that they own. So they might put in their own company if they have the ability to do that. Write a check every now and then, hopefully try to get under the radar is what they're trying to do, or create a fictitious service, fictitious invoice, get that paid through the system somehow. That's how an employee could get those fictitious vendors set up and have checks paid out to them. Employee payments from customers and purposely misapply those payments to different accounts to try to hide their theft of cash. So they're constantly manipulating the accounts of customers, hoping that no one really catches on. This usually happens in large uh, companies that have a lot of movement of cash that people have a hard time keeping track of, yet the individual has enough ability to take that cash and somehow convert it, or those checks and somehow convert it. An example of this is a property tax division within a large multinational company. The individual would purposefully overpay the property taxes. So when the municipality would call back and say, we need to issue a refund check for your overpayment, he had set up another business with a very similar name to the company with property management at the end of it, and told them they needed that check written to that property management company that was really his company. So every time they overpaid their property taxes, those refund checks would get diverted into his own special setup cash account.